So touching now on bonds, particularly government bonds and treasury bills. So as in an election year, we are seeing actually a higher fiscal deficit by the government, not just particularly because it's an election year, but also on the back of where we've come from, especially on the back of COVID-19. COVID-19 still remains with us, and therefore there are certain measures the government is taking towards making sure that we're safe and making sure that vaccine rollouts are ongoing. So there's increased budget to make sure there's increased vaccine rollouts. At the same time, the government is looking to build sort of a vaccine sort of center in which they'll be able to manufacture some vaccines which can be used by the population. At the same time, what will lead to an increased fiscal deficit is the fact that we do have elections, and about 8.8 billion shillings will be allocated to the IBC to facilitate the elections in August. And also there is some infrastructure spending that will be used as well this particular year, especially when it comes to roads and as well as the railway, to name a few. And so if you combine the efforts that are being made on that side, as well as supporting what they call sort of state-owned enterprises, including, for example, KQ, including public universities, which do have an allocation to be made this particular year to support those enterprises, then therefore there's an increased load that the government will need to meet in the next 6 to 12 months. And therefore we're likely to see a rising interest rate environment, because we're seeing currently that rates have gone up. If you look at the implied yield curve for government bonds, we've seen a shift upwards. So a shift upwards, if you compare since the beginning of 2022 until now, where we're in about mid-February, we've seen the yield curve go upwards across the tenor. This is from the T-bills all the way to the highest bond, which is a 25-year bond. So we've seen rates go up. We saw that trend also that trend was the same case from June of 2021 until the end of December 2021, and that is the case. So what happens when interest rates go up? The prices of bonds tend to go down. So if you're holding bonds and you're marking them to market, meaning that you're an investor who looks to buy bonds and then sell them in the market or in the secondary market, you're likely to book some losses because the rates are going up. If you're a bond investor who's holding your bonds to maturity, meaning if you invested in a 10-year bond, you're looking to hold that bond for the whole 10 years, then you don't experience that fluctuation. So for the most part, if you're having capital, one of the ways you can look at it is, if you're investing in bonds, it could be a good time, especially if you're holding them to maturity, because you're getting higher rates on those bonds. We're seeing, for example, in this particular month, the government is looking to raise a 75 billion shilling infrastructure bond. That will be a 19-year bond, and based on that particular bond and based on the views that we've had from various investors, it's likely to be oversubscribed. It's likely to see a new level of rates. The infrastructure bond will be held at. So rates are going up. There are opportunities for such investors, and if you're marking to market, then it's a good time to reevaluate your portfolio and see, based on an outlook of rising rates, what type of stance do you want to take, given that this is an expectation that will occur at least for the next about 6 months to 12 months in regard to rising interest rates. The government, when it comes to being a risk-free bond, still remains so. The government remains strong. If you look at, for example, what they've been able to do in terms of revenue, the revenue is up over the last 6 months from June to December. They were up about 1.6%, which is about 16.6 billion above their target. And this is actually the first time in a long time that we've seen the government actually raise more money above their target when it comes to revenue. And we're likely to see, and their targets has actually rose when it comes to how much they're expecting to raise when it comes to by the end of June 2022, which is the end of the fiscal year. So the revenue targets are going up. We saw the curfews being lifted in October 2021, and we've seen sort of an upsurge there, and that has been a benefit to the government in terms of taxes, in terms of also the amount of money they've been able to receive as well from different distributions, and also there are initiatives that the government can still take. For example, there was a minimum turnover tax, which was temporarily shut down by the courts. But also that's a measure as well as an annual inflation adjusted on the excise tax, which have not yet been approved. So those are also additional measures that can be taken by government to raise their revenues. And also during that 6 months, we did see that the government was below target when it came to expenditure, and so you had a sweet situation where there was a bit of a fiscal surplus in regard to how much revenue they were receiving against how much they were willing to expend. Something else that we will see in the environment is, especially when it comes to government, is they're likely to do a Eurobond. What's been in the market around what we've been hearing is they did a Eurobond last year of 1 billion. They could do another Eurobond of 1 billion or even more, and they're likely to do it in the first half of the year, at least before the end of the fiscal year. So the markets right now, we're seeing a rising rate, not just in Kenya but also across the world. We're seeing for the most part in the US, we're seeing they're likely to raise their federal rate reserves by about maybe around 150 basis points by the end of the year, or I'd say 3 levels over time, and so there's anticipation of what they could do given the interest rates on a rising level. And so with that environment, we're likely to see maybe rates go up on the Eurobond market, but at the same time it still remains a good market, given that we saw, for example, oversubscription of the Eurobond last year quite significantly, and we're likely to see that demand spill over to this year. So the government could take advantage of that. That will increase our reserves and could also hold favorable to the Kenya shilling, even though the Kenya shilling is seen to depreciate. At the same time, having more reserves with a minimum reserve level that we expected to hold of about 4.5 months. Currently we're holding about 5.1 months, so we'll be at a fairly good level. So I think overall, as a government investing government bonds, I think for this year it'll be safe, even though we're going to see a transition to a new government with a new new president at the helm, but fiscally the government still remains fairly strong and are able to meet currently are able to meet both their external as well as their domestic targets. I mean their domestic debt targets, and also repay those bonds as they've have in the past. So at least we haven't seen any default from Kenya in recent years, and it's remained strong. The credit rating we still remain within a B minor when it comes to the Fitch credit rating, and that still remains, if you compare to other countries, that still remains fairly even if compared to us with other countries with similar GDP sizes. And so we've only seen sort of downgrades, for example Ghana, whose rates are significantly up due to a very rising fiscal deficit. But I think Kenya will be able to maintain the fiscal deficit within good levels, given that we've seen also revenue pick up. So I think government bonds are a good investment, especially when it comes to the medium to long run, and that's something that you can alternate, especially if you're looking at a more wholesome portfolio where you're looking to invest in both cash, keeping some liquidity, but at the same time you want some higher interest rates. Then government bonds will fit that, and as well, if you're looking to take more risk, then equities could perhaps fit into that. But I think government bonds as a whole, especially Kenyan government bonds, are a good investment bet for long-term investors. So thank you.